Imagine waking up tomorrow owning one of the largest water utilities in America. No flashy headquarters, no celebrity founder, no app you've ever heard of, just pipes buried under the ground, a few treatment plants humming quietly on the edge of town, and millions of people who will pay you every single month for the rest of their lives. Because they have no choice. At first that sounds almost boring. Water is water, you collect it, clean it, and sell it. What could possibly be complicated about that? But here's where everything changes, because the truth is, owning a water utility is one of the strangest, most misunderstood businesses on the planet. It behaves nothing like a normal company. It doesn't compete for customers. It doesn't chase growth the way tech firms do. In many ways, it isn't even trying to make more money from water at all. And near the end of this video, you'll discover the one hidden reality almost nobody talks about: the actual reason water utilities are considered one of the most quietly profitable industries in the world. Once you hear it, you will never look at your own water bill the same way again. But to understand that secret, we first need to understand what this business actually is. A water utility exists to do one job society cannot survive without. It pulls water from rivers, lakes, reservoirs, or underground aquifers, cleans it to a standard safe enough to drink, pushes it through a hidden network of pipes, and delivers it to homes, offices, hospitals, schools, and factories. Then, in most cases, it collects that same water again after it's been used, cleans it a second time, and returns it safely to nature. Most people assume this is a simple utility service, something the government just handles quietly in the background. And in many places, that's true. But in thousands of communities across the world, water is actually run like a business, with investors, shareholders, regulators, and very real financial pressure. This is where most people are wrong. Because whether a water utility is government-owned or privately owned, it still has to behave like a company. It still has revenue targets. It still has debt to service. It still has to justify every dollar it spends to a regulator watching its every move. And that regulator is the single most powerful character in this entire story. Now think about this. In almost every other industry, if a company wants to raise prices, it just raises them. If customers don't like it, they switch to a competitor. But a water utility cannot do that, because in the vast majority of cases, it has no competitor at all. There is no second water company delivering pipes to your house. There is no shop around for a better deal. This is what economists call a natural monopoly, a business where it makes far more financial sense to have one company build and maintain the entire network instead of 2 or 3 companies fighting over the same streets and duplicating the same pipes. Because of that monopoly power, someone has to step in and make sure the company doesn't take advantage of customers who literally cannot leave. That someone is the regulator, often a state or national utility commission. And this single relationship between the company and its regulator controls almost everything about how this business makes money. So who actually owns these systems? In most countries, ownership falls into a few very different categories, and each one changes the entire financial story. The first is government or municipal ownership, where a city or public authority owns and operates the water system directly. This is the most common model in the world. It's usually non-profit in structure, meaning the goal isn't to generate returns for shareholders, but simply to cover costs and maintain the system responsibly. The second is investor-owned utilities, publicly traded companies that operate water systems as regulated businesses. These are real corporations, some with billions of dollars in market value, and they answer to shareholders the same way any other public company does. The third is private concession or contract operation, where a private company is hired to run a system that a government still technically owns. The private company manages daily operations and infrastructure, often under a long-term contract lasting 20, 30, even 50 years. And the fourth is cooperative ownership, most common in smaller or rural communities, where the customers themselves technically own the utility collectively, almost like a financial cooperative built around water instead of banking. Each of these ownership structures affects who takes the financial risk, who earns the profit, and who ultimately pays if something goes wrong. But regardless of ownership, here's the part almost nobody thinks about. If you owned this business, what would you actually be buying? Because this is not a business built on inventory or storefronts. What you're really purchasing is one of the most capital-intensive physical networks on Earth. You're buying the land beneath treatment plants and pumping stations. You're buying reservoirs and intake structures that pull raw water from rivers or aquifers. You're buying treatment facilities filled with filtration systems, chemical dosing equipment, and disinfection technology. You're buying pumping stations that push water uphill and across entire cities using enormous amounts of electricity. You're buying storage tanks that sit quietly on hillsides, holding emergency supply for entire neighborhoods. You're buying water rights, legal permissions that determine how much water you're even allowed to withdraw from nature in the first place. And underneath everything else, you're buying an almost unimaginable length of underground pipeline, sometimes stretching thousands of miles beneath a single city. That underground network is the true heart of this business, and it's also the most expensive part. Now think about the cost of building all of that from scratch. Constructing a mid-sized water treatment plant can cost tens of millions of dollars. Reservoirs and storage infrastructure add tens of millions more. And the pipeline network itself, depending on the size of the city, can easily reach into the hundreds of millions or even billions of dollars. Once you include distribution lines, service connections, and pumping infrastructure. Then come the permits, environmental studies, engineering reviews, public hearings, financing structures that often require government-backed bonds because private lenders see this as an extremely long-term, capital-heavy investment. This is why almost no water utility is built purely with private cash. Instead, they're financed through a mix of municipal bonds, infrastructure loans, and, in regulated private utilities, direct investment from shareholders, expecting a long-term stable return. And this is where the real story begins, because here's the twist most people never expect. Water utilities don't really make their money by selling water. At first, that sounds impossible. Isn't water literally the product, but the actual liquid itself is incredibly cheap? What customers are truly paying for is everything required to deliver it safely, reliably, and legally, day after day, for decades. In other words, customers aren't buying water, they're buying infrastructure, reliability, and public health protection. The revenue model works like this. Residential customers pay monthly based on how much water they use, often billed per 1,000 gallons or per cubic meter. Commercial customers from restaurants to office towers typically pay higher rates because their usage patterns place different demands on the system. Industrial customers, especially manufacturers, pay based on far larger consumption levels and sometimes even different water quality requirements. But that's only one part of the story, because most utilities also collect secondary revenue through wastewater treatment fees, essentially charging customers again to clean the water after it's been used. There are also connection fees and tap fees charged whenever a new building or development joins the system, sometimes costing thousands of dollars per property. And there are infrastructure surcharges, small additional fees layered onto bills, specifically to fund pipeline replacement and system upgrades. All of this creates something rare in the business world, a revenue stream that is almost shockingly predictable. People don't stop drinking water during a recession. They don't stop showering because of inflation. Demand barely moves compared to almost any other industry you can imagine. But here's what almost nobody realizes. This predictability isn't really the reason these companies stay profitable. The real reason lies in how money is allowed to flow through the system. In a regulated water utility, here's how the actual financial machine works. The company proposes a rate case to its regulator, essentially requesting permission to charge customers a certain price. That rate case includes the cost of operations, maintenance, and any new infrastructure investment planned for the coming years. The regulator studies this request in incredible detail, often taking months, sometimes years, before approving new rates. If approved, the utility is guaranteed to recover its costs, plus a set rate of return directly from customer bills. This changes everything about how the business behaves, because in a normal company, spending more money reduces profit. But in a regulated water utility, spending more money on infrastructure can actually increase the size of what's called the rate base, the total value of infrastructure investment the company is allowed to earn a guaranteed return on. Read that again slowly, because this is one of the strangest financial mechanics in the entire corporate world. The more a water utility invests in pipelines, treatment plants, and equipment, the larger its allowed profit becomes, because regulators typically permit a fixed percentage return on all invested capital, often somewhere between 8 and 11%, depending on the region and risk level. This means water utilities aren't incentivized to minimize spending the way most businesses are. They're incentivized to invest heavily in long-term infrastructure, because that investment becomes the very foundation their profit is calculated from. But don't mistake this for easy money, because right behind every dollar of revenue sits an equally enormous wall of expenses. Labor costs come first, since operating treatment plants, maintaining pipelines, and managing customer service requires a skilled workforce running operations 24 hours a day, all year long. Energy costs follow closely behind, because pumping and treating water requires enormous electricity consumption, especially in hilly or spread-out service areas. Chemical costs add another significant expense, from chlorine and coagulants used in treatment to specialized chemicals required for advanced filtration. Debt service becomes a permanent fixture too, since most infrastructure projects are financed through long-term bonds that must be repaid over 20, 30, even 50 years. Insurance and liability protection add another steady cost, particularly important given the public health responsibility involved. And regulatory compliance, monitoring water quality, testing for contaminants, and reporting results to government agencies requires continuous investment in laboratory testing and specialized technical staff. At first, all of this seems manageable. Predictable revenue, predictable expenses. Until you discover the hidden costs almost nobody accounts for until it's too late. Because here's a shocking truth about this industry. In most developed countries, a significant percentage of treated water never even reaches a paying customer. It's lost through what's called non-revenue water, meaning leaks, aging pipe failures, and undetected underground losses. In some cities, this number can reach as high as 20 or 30% of total treated water. Water the utility paid to clean and pump, but never got paid for. This single issue alone costs utilities enormous amounts of money every year, and it's directly connected to something even bigger, the age of the infrastructure itself. because many major water systems were built generations ago, sometimes over 100 years ago, using pipe materials that were never designed to last this long. Replacing an entire underground network isn't simple or cheap. In fact, in many cities, replacing old infrastructure is significantly more expensive than building a brand new system from scratch, because crews have to dig beneath existing streets, avoid other utility lines, and work carefully around communities that still need water service during construction. This tiny detail costs some cities and utilities billions of dollars in deferred maintenance backlog, infrastructure repairs that are known and necessary, but constantly delayed due to cost and disruption. And then there is an even more serious hidden risk: contamination liability. Utilities operating older systems, particularly those with lead service lines, face enormous legal and public health exposure. Regulatory standards continue tightening around lead, certain industrial chemicals, and emerging contaminants, forcing utilities into expensive infrastructure upgrades they didn't originally plan for. Add to that climate-related risk. Extended droughts can shrink available water supply. Sudden storms can overwhelm treatment system. Wildfires can damage watershed areas that feed reservoirs. Rising sea levels can threaten coastal treatment facilities. Every one of these environmental shifts adds financial pressure that didn't exist in the same way decades ago. So with all of these hidden costs stacked against predictable revenue, how profitable is this business really? The answer depends heavily on ownership structure. Government-owned utilities generally aren't designed to generate profit at all. Their financial goal is simply to break even while maintaining safe, reliable service. Investor-owned utilities operate differently, targeting that regulator-approved rate of return, typically resulting in stable, moderate profit margins rather than explosive growth. This is not a business built for rapid financial upside. It's a business built for extremely long-term, low volatility, dependable cash flow, which is exactly why long-term investors, pension funds, and infrastructure funds are so attracted to this industry. It behaves less like a high-growth company and more like a bond that happens to deliver drinking water. But here's where things get more dangerous. Because despite this stability, water utilities absolutely can fail financially, and it happens more often than people assume. Smaller utilities, particularly in rural areas, often struggle because their customer base is too small to spread out the enormous fixed costs of running a treatment plant and pipeline network. Poor management decisions, especially delaying necessary infrastructure investment to avoid raising customer rates, often lead to sudden catastrophic failures instead of gradual affordable fixes. Excessive debt taken on for oversized infrastructure projects can crush smaller systems that don't have enough customers to repay it. And economic downturns, especially in industrial or manufacturing-heavy regions, can dramatically shrink commercial and industrial water demand, removing a significant portion of expected revenue. This is where most people misunderstand the danger completely. The threat to a water utility usually isn't losing customers to a competitor. It's the slow, quiet accumulation of deferred maintenance and technical debt until one day a major pipe bursts, a treatment plant fails inspection, or a contamination event forces emergency spending far larger than anything the utility planned for. And this leads to an even bigger problem shaping the future of the entire industry, because now artificial intelligence, sensor technology, and predictive analytics are transforming how these systems are managed. Smart water meters allow utilities to detect unusual water usage patterns in real time, helping identify leaks long before they become emergencies. Acoustic sensors placed underground can detect the subtle sound signatures of pipe leaks long before a visible break occurs. Predictive maintenance software analyzes pipe age, material, soil conditions, and historical failure data to forecast which sections of pipeline are most likely to fail next, allowing utilities to replace infrastructure proactively instead of reactively. This technological shift is quietly reshaping the economics of the entire industry, reducing water loss, lowering emergency repair costs, and extending the usable life of aging infrastructure. At the same time, climate adaptation is becoming one of the biggest long-term financial factors utilities must plan for. Investment in alternative water sources, advanced drought-resistant infrastructure, and stronger reservoir management is becoming less of an option and more of a financial necessity. So after everything we've explored, the ownership structures, the infrastructure costs, the revenue model, the hidden risks, and the emerging technology, we return to the beginning. Because remember the promise from the start of this video, the hidden reality almost nobody talks about. Here it is. Water utilities are not primarily in the business of selling water. They are, in the truest financial sense, in the business of building and owning infrastructure, because regulators guarantee them a return on every dollar of capital they invest into the system. This means the real engine of profit in this industry isn't consumption, it's construction. The pipelines, treatment plants, and pumping stations aren't just tools used to deliver the product. They are the product, financially speaking, because they form the very foundation that determines how much profit the company is legally allowed to earn. This is why water utilities continuously invest in massive infrastructure projects, not purely out of necessity, but because that investment directly expands their allowed earnings. It's a business model where spending money and making money are not opposites, but often two sides of the exact same financial equation. So the next time you turn on a faucet and watch clean water flow out instantly, remember what's actually happening behind that simple moment. You're not just paying for water, you're funding one of the largest, quietest, most misunderstood infrastructure empires in the modern economy. One pipe, one treatment plant, and one guaranteed return at a time.